150 billion euros, 65%, 2030. Those three numbers tell you almost everything you need to know about Europe's next defense trade. 150 billion euros is the scale, 2030 is the window, and 65% is the industrial filter. In this video, we're going to talk about the SAFE program, a powerful European Union financial instrument that is already being implemented as we speak. So this is no longer just a story about Europe spending more on defense. This is real money, at real scale, starting to flow into the economy. The real question is, who actually gets that money, and could this be the beginning of an EU defense supercycle? Before we jump to the stock names, one quick point. What actually is SAFE? It stands for Security Action for Europe, and in simple terms, it is the EU's new defense financing tool. It gives member states access to up to 150 billion euros in long maturity loans to fund urgent defense spending through common purchasing. The regulation entered into force in May 2025. The first national plans were approved by the European Commission in January 2026, and the first payments were expected to begin in March 2026. So SAFE is no longer just a policy headline. It is now moving from legislation to actual money. SAFE matters because it is not just another Brussels announcement. It is a financing mechanism tied to specific procurement categories. Category 1 includes ammunition, missiles, artillery, land systems, small drones, critical infrastructure protection, cyber, and military mobility. Category 2 includes air and missile defense, larger drones, space assets, artificial intelligence, and electronic warfare. And the structure matters just as much as the categories. Because of the 65% European content requirement, plus design control requirements and more complex systems, SAFE favors companies with European supply chains and real industrial control over what they sell. That is the key point. SAFE is not just spending money, it is also steering money. So the likely winners are not simply defense stocks, they are the companies sitting closest to funded categories, industrial bottlenecks, and European production capacity. And this is where the story gets more interesting, because SAFE may not be a one-off. It may be the opening phase of a broader European defense supercycle, a multi-year period where policy, budgets, industrial capacity, and procurement all reinforce each other. And Europe is moving in that direction. SAFE is the first pillar of the broader Readiness 2030 push, which aims to unlock more than 800 billion euros in defense spending across the EU by the end of the decade. The original SAFE envelope was also fully taken up. 19 EU countries applied for the loans, and applications reportedly reached about 190 billion euros, above the original 150 billion. That matters. Because when a program gets oversubscribed that fast, markets start asking a new question. Was this the package, or just the first package? And that question is no longer theoretical. Reuters reported that the Commission has been considering a second edition of the SAFE loan scheme, though no final decision has been made. So I would not present SAFE 2 as a fact, but I would absolutely present it as a credible possibility. And that is exactly why this may be the beginning of a cycle, not just a trade. Before going deeper, here is a short version of which companies can be the winners. Rheinmetall is the scale and delivery name, CSG is the bottleneck and asymmetry name, Leonardo is the systems and state alignment name. That is the ranking framework for this whole video. Not hype, not patriotism, not vibes, just one question. Where is finance demand most likely to land first? The first name is Rheinmetall, the largest German arms manufacturer headquartered in Dusseldorf. If you want the cleanest listed proxy for the land and ammunition side of Europe's rearmament cycle, this is probably it. And for this video, the best way to frame Rheinmetall is through scale and operating leverage. Rheinmetall is at roughly 9.9 billion euros of 2025 revenue with an estimated EBITDA margin of almost 22%. That tells you two things. First, this is already a very large platform. Second, it is not just growing, it is scaling with improving economics. That matters because SAFE is likely to favor companies that can absorb contracts quickly, expand output, and convert volume into earnings. Rheinmetall fits that profile better than almost anyone in Europe, and there is also a demand visibility angle here. The last clean company reported backlog figure was almost 64 billion euros at the end of 2025, so even before the next SAFE-driven procurement wave, this was already a business entering 2025 with major order support. That is why the Rheinmetall thesis is simple. If SAFE accelerates spending on ammunition, artillery, and land systems, Rheinmetall is one of the first names through the filter. That is why I rank it first. But it is also the most obvious trade in the basket. So if Rheinmetall is the obvious winner, where is the better asymmetry? My answer is the bottleneck supplier. That brings us to CSG, which is Czechoslovak Group. It is headquartered in Prague, but is listed on the Amsterdam Stock Exchange since January 2026. It was described as a record defense sector IPO in Europe. The offer price was 25 euros per share, but after the initial enthusiasm, the stock now trades well below that level. In the beginning, the market had real appetite for the story. Europe's ammunition bottlenecks and the operating profile seemed strong. In 2025, CSG reported nearly 6.75 billion euros in revenue and more than 1.7 billion euros in EBITDA, which implies a margin of almost 26%. That is not a normal industrial profile. That is a bottleneck profile, and that is why CSG fits the thesis so well. But the story may have looked a little too good to be true. After the IPO, a series of controversies began to emerge. The biggest blow came when Hunter Brook Research published a report laying out those concerns in detail. The allegations include overstating production capacity, presenting resale activity as manufacturing, highlighting non-binding deals as evidence of growth, and under-disclosing key risks during the IPO. You can find a link to the full report in the description. CSG rejected the report, calling it inaccurate and selective. Even so, it clearly adds another layer of risk to the investment case, but it also makes it more interesting. So now we have the obvious winner and the bottleneck winner. The third name matters for a different reason. What if the next phase is not just replenishment? What if it is systems? That is where Leonardo comes in. Leonardo is not the pure ammo trade, it is the systems trade, and that matters because SAFE is not only about ammunition and vehicles. It also supports air and missile defense, electronics, sensors, drones, and higher value mission systems. That gives Leonardo a very different exposure profile from Rheinmetall and CSG. Leonardo is at roughly 19.4 billion euros of 2025 revenue and about 2.45 billion of EBITDA, and the company's 2025 preliminary materials show backlog at roughly 46.6 billion euros at year-end. So Leonardo is not the margin monster in this basket, but that is not the point. The point is strategic relevance. If European defense spending broadens from urgent replenishment into more integrated capability building, Leonardo becomes much harder to ignore, and the political backdrop strengthens that case. Italy is set to be one of the largest SAFE funding recipients, with about 14.9 billion euros allocated, and Leonardo's largest shareholder remains Italy's Ministry of Economy and Finance, with about 30.204% of the share capital. That does not guarantee contracts, but it absolutely matters when procurement runs through national ministries, and industrial policy starts to matter more. So Leonardo stays in the basket, not because it is the cleanest first-order SAFE winner, but because it is one of the strongest second-order winners if the cycle moves up the value chain. So let's reduce it. Why these three? Because each one maps to a different part of the SAFE thesis. Rheinmetall is the scale and delivery name, CSG is the bottleneck and asymmetry name, Leonardo is the systems and political alignment name. And together, they cover the parts of the value chain most likely to matter under SAFE: ammunition and artillery, industrial inputs and capacity, complex systems integration. That is a much stronger framework than simply saying Europe is rearming, buy defense. Now, the risks. The first risk is obvious. This trade is crowded. The market has already identified the broad theme, so from here, investors need execution, not just headlines. The second risk is capacity. SAFE can unlock funding faster than Europe can build propellant, nitrocellulose, missiles, electronics, and finished systems. That is one reason why I prefer names already close to production. The third risk is procurement friction. SAFE may be European in structure, but contracts still move through national ministries, consortium politics, and industrial bargaining. Money can be approved faster than equipment can actually be built and delivered. And the last risk is the one investors should not ignore. What happens after 2030? If Europe builds a lot of new capacity and fails to follow SAFE with more long-term demand support, parts of the industry could face pressure later in the cycle. That matters most in ammunition, so the thesis is strong, but the time horizon matters too. So here is the thesis in one line. SAFE is not just a defense headline, it is a financing mechanism with an industrial filter. The scale is 150 billion euros, the filter is 65% European content, and the window runs through 2030. That is why three names stand out. Rheinmetall first, the clearest land and ammo beneficiary. CSG second, the more asymmetric bottleneck play, now clearly public after the January IPO. Leonardo third, the systems and state alignment name if SAFE broadens into more complex capability building. And the bigger point is this: if SAFE gets followed by additional rounds or becomes a template for broader EU defense financing, then this may end up looking less like a one-off procurement story and more like the start of a European defense supercycle. Not certainty, but a credible setup. Not every defense stock benefits equally from that. These three have a stronger case than most. This is capital rotation. We look for the capital flows behind the headlines.